Well, good morning, everyone. This is Eric Brupold with the San Diego North EDC. I've got it right now at 9:01. So if we have some last minute or people kind of logging in a little late, they will be able to get the bulk of the presentation since we'll have a little bit of preliminaries. I want to welcome you to another one of our business education webinars. SDNEDC has been doing those since we began the virtual or the shutdown for eliminating in-person events. But we're excited to be doing this one. We'll probably do some more, but we're excited also to get back to hopefully our Lunch and Learn series in the fall that'll cover similar topics to what we've done in the past and what we're going to do today. Information that's focused on economic development and opportunities to improve competitiveness for North County businesses to help them expand and thrive. Today, we're going to cover a couple of new changes that have occurred in federal legislation and in tax regulations in some of the key tax credit programs that are available to small and mid-sized North County businesses. To let kind of the format for today is we're going to go through the presentation, the first part, which is going to focus on the Employee Retention Tax Credit Program, which was put in place just recently in some of the COVID legislation. We'll take questions and answers in chat, and then the second half of the webinar will focus on the R&D tax credit. We know for some of you, your business operations are not focused on tax credit issues, research and development tax credit opportunities. And so feel free once you have finished to jump off. This webinar will be made available on the SDNEDC website as a YouTube. We'll get out to all the registrants that link. So if there's something that you missed or that you want to review or you want to share it with other people in your organization, that will be available. Again, my name is Eric Brupold. I'm the CEO of the San Diego North Economic Development Council. We are the economic development organization that operates in San Diego County, north of SR 56. And we focus on the three classic pillars of economic development. We help market North County for inward investment, work with existing businesses to help them expand and retain that employment in our region, and connect employers and educators to strengthen our workforce pipeline. A public-private partnership, and one of the things that I would be remiss if I didn't remind attendees is that while half of our resources come from the public sector, half of it comes from the private sector. And if this is of value to you, we would love to have you become part of the SDNEDC family. We like making available these resources to our business community here in North County, but obviously more resources help us do more of that. You can learn about that on our website and through our newsletter, our website being sdnedc.org. With those preliminaries out of the way, I'm really happy to introduce a longstanding investor in SDNEDC, Polito and Epic and Associates, and one of their partners, Jessica Dorsett. She is also our tax preparer here at the council and has been an invaluable resource to help guide our work. I won't go through Jessica's whole bio. She's involved with several organizations and several nonprofits in North County. She's a graduate of one of our fine institutions of learning here in San Diego and the University of San Diego, joined Polito and Epic after university and has worked her way up in the practice to become a partner. And then a new part of the SDNEDC family is Alliant Group. Alliant Group is an entity focused almost exclusively on helping businesses navigate research and development and other tax credits that are available. And we're excited to be joined by Justin McNally from Alliant Group. He's licensed to practice law in the state of Texas, but we don't hold that against him. We just remind him that while They're California companies moving to Texas. We get all their brain powers. So they come out here to grow their companies. So with that short introduction, I'm going to kick it over to Jessica, who will expand a little bit more, and then we'll get into the meat of the presentation.
Thank you, Eric, and thank you everyone for joining us. I'm really excited to be able to bring this resource to the community of North San Diego County. Polito Epic is a local firm. We provide service, accounting, and business consulting services to closely held businesses in our community and their owners. That is kind of our niche, and that is everywhere around us. So this resource, this kind of relationship that we've built with Alliant Group, I thought would just be a really valuable resource to bring to the community. So I'm excited that they're here for, to do that with us today. So Justin will be taking care of most of this presentation today. We will kind of try to engage in some conversation. I'm going to be asking some questions that I think you all would be asking. I will also be monitoring your questions, and we'll bring those into it as appropriate. But I'll go ahead and pass it over to Justin.
Thanks, Jessica. And thanks, Eric, for the ringing endorsement for my law degree as well in the state of Texas. It really is a pleasure, everybody. And thank you so much, Erica and Jessica, for helping bring us into the family and educate all of the members here. I just want to spend 2 minutes, everybody, just as a quick introduction of Alliant Group. Like Eric mentioned, look, we're a specialist when it comes to very nuanced credits and incentives for small to medium-sized businesses. Since our founding in the early 2000s to date now, when you add up R&D credits, the employee retention credit, as well as a few other very specialized deductions or credits that are out there, we've put back over $13 billion into U.S. businesses. Now, what's most exciting for us about this and our whole mission of why we got into this in the first place is the jobs numbers. So as you see, I mean, we partner with firms like Jessica and Polito and Epic to help serve their communities in these very complex areas. But that 13 billion has led to over 200,000 jobs right here in the US. And the way we've done that is unique. We've built a very strong team, and I highlight these folks not because they're figureheads, they're actually fully on our staff. The few people that I'd really like to highlight for you is, as you look at the bottom right, you have Mark Everson, Steve Miller, Kathy Petronchek. These are actually all former commissioners of the IRS. So the reason we brought these folks on staff, and we've actually recently added a fourth in a couple of weeks, is to ensure that no matter what credit that we're working on, is that it's perfectly in line with not only the intent behind the law, but it's in compliance, with current regulations. So the way we do that is unique. We call this, you can think of it as a three-legged stool. We have the enforcement arm with our former IRS commissioners, but then importantly, on the legislative side, you saw Dean Zerbe and Don Levy. They are both heads of the Senate Finance Committee on either side of the aisle. And the reason we've always had this approach is employee retention credit, which we're about to talk through with Jessica, is a great example of where it's really had support on both sides. Trump signed it into law, that administration at the end of last year, and then the Biden administration extended it, as soon as they came through. So what's exciting is it really is a way that dollars can go back to businesses. And then, again, as Eric mentioned, our bread and butter. We've also done the R&D credit, which we'll cover later in today's presentation. But to do that, you do have to have a very technical built group. So our staff, we're about 1,200 people. 800 of our folks actually come from industry. So they're architects, they're engineers, chemists. My background, aside from my legal background, I'm also a biomedical engineer by trade. So our whole goal is to make sure that we're getting the right facts. We're working with your business to make sure that any dollar that you're entitled to, you're getting. So Jessica, I think, we'll start with the employee retention credit. Would it be helpful for me just to kind of give a quick overview to start, or did you have any initial questions?
I think giving the basic kind of who qualifies, our are there any entities that don't qualify, you know, that kind of thing, and then go from there.
Perfect. Yeah. So I'm not sure how many of you guys have heard of the employee retention credit. Our whole purpose and why we actually started helping with this is there was so much with PPP and employee retention credits and it was changing. I think everybody on here could think of how the rules just kept changing on them. It seemed like week by week. Not to mention to add in the complexities of California trying to figure out how they wanted to handle stuff. So what the employee retention credit, just as a broad overview, because there's really two of them. There was the employee retention credit that was passed under the CARES Act, and then the new employee retention credit for 2021 that was signed into law at the end of last year, and then, as mentioned, recently extended through the Biden administration. But as a quick overview, the employee retention credit is a fully refundable tax credit that is applied against your payroll tax, right? And the whole intent of why this was put in place was to help any business that was impacted by the pandemic, right? So as an overview of just how it works and who can be eligible, again, the first credit that applied to 2020 was signed into law under the CARES Act. The whole purpose then was that if you were a business that was impacted either through a partial shutdown, right, or any government orders, or had a decrease in your revenue, then you could qualify for an incentive for a particular quarter as compared to 2019. And then under the Consolidated Authorizations Act in 2021, again, this was changed. So they updated the rules. They now not only increased the value for 2020, it's $5,000 per employee, right, for the entire year. For 2021, what was so exciting is they changed that to say you could actually capture up to $7,000 per employee per quarter, right, for Q1, Q2, Q3, and Q4 of 2021. And so these modifications at the bottom that were so critical is, one, they wanted to simplify it to an extent to help other taxpayers and businesses take advantage of this. And again, trying to put more dollars back, because businesses, even for businesses that saw maybe a slight spike in revenue coming through this pandemic, they're still playing it off on the back end as we're rolling into 2021 and 2022 and the uncertainty of how the business is going to do. So there's some common myths, and Jessica's been so helpful because we've talked through these around, hey, my business doesn't qualify for ERC. And a lot of this comes from as we all know, the IRS is not the fastest moving organization. So even for a long time through most of this year, they still had the old rules posted on their website. It took a long time to get that done just due to resource constraints. So there's some common misconceptions around this credit that I felt were really important to highlight. One is a partial shutdown. I think a lot of people think, oh man, I need to have some sort of full shutdown to qualify. That's not necessarily the case. Similarly, a disruption in my business, what does that mean, right? What is a disruption? Same with access to equipment, limited capacity, suspensions of supply chain. These are all examples that we are seeing with businesses that in some way, whether you're in manufacturing, whether you're a nonprofit, whether you're in the services industry, they're still qualifying in at least one quarter, right, through all of this. So the first real myth that I wanted to discuss around this, and I hear this all the time, is I can't take advantage of ERC because I took PPP, right? That was actually when the first employee retention credit was signed into law under the CARES Act. That was the case. They had a rule in there that if you had taken PPP, you could not qualify. Now, when they extended it under the new rules for 2021, they repealed that rule. So now, even if your business did take advantage of PPP, you can still qualify for the employee retention credit, which is really exciting because it's just another way to get funds back into the business. And similarly, this is, and Jessica, you've probably heard this too. My PPP loans were forgiven, right? How can I still be eligible for this? That's what's helpful, and this is why we break it out mathematically, is even if you applied 100% of your PPP monies to payroll, right, you would still only account for 2.5, times of your monthly payroll expenses. So there still leaves dollars on the table at the end of the day that could be eligible for ERC. And frankly, we've now, especially across the state of California, Southern California, and specifically in North County and the San Diego area, just due to the number of restrictions and orders, right, that have been in place, we're seeing businesses qualify at a much higher rate for at least 1 quarter of this credit. And this is, again, another point when it comes to the sales side. So as you remember, there's really 2 general ways to qualify for this credit. First off, did I have a revenue drop, right? For the 2020 credit, if you had a 50% decline in revenue in any quarter in 2020 as compared to 2019, then you can qualify. I like to term this as kind of a safe harbor rule, right? This is an area that if you had a revenue drop, then you can look at this credit for your business, right, and for your employees. For 2021, the rules changed. They now made it to where if you had a 20% drop in revenue in 1 quarter as compared to another quarter in 2019, then you could qualify. So for example, and this is why the timing of this is so good now, for Q2 of 2021, the timely file deadline for a lot of businesses, depending on your payroll provider, will be coming up either the end of this month or in July, depending on when your payroll provider likes to process things. If you compared this quarter to the same quarter in 2019, and there was a 20% decline in revenue, then that is one way you can qualify. Additionally, like this myth says, there are businesses that went through this and in a quarter maybe were flat, maybe didn't have that significant of a drop in revenue, or especially when you think of construction or even manufacturing, right, and some other industries, they actually had pretty good years depending on their client sector, right? But that doesn't mean they still can't qualify for this credit, because at the end of the day, if they were impacted in one of the many factors that were listed before, that's a potential way that they could still qualify. And if you are located in a county, which I would think most of the folks on here are, as part of the North County, it would be hard to say that there was not some sort of government order in place during this time period that could have had an impact on your business, right?
So Justin, so if I'm hearing you right, we can go back to that slide.
Sure.
The look back on revenues to look for the 20% drop is what you're calling more of an easy safe harbor, but that's not the only way to qualify. So even if you didn't meet that revenue drop, these other factors come into play, then you can still qualify.
That's absolutely right.
Okay.
Yeah. So you can qualify under that revenue, but even if you don't, you can still potentially qualify.
And is it something that you have to reassert every quarter, or is it just that 1 quarter qualifying you opens it up for the whole, for every quarter?
No, great question. So it is a quarter by quarter analysis.
Okay.
So you would always compare, that your current quarter to the same quarter in 2019. Or you do have an option to look, because Congress recognized that not all businesses, especially small to medium-sized businesses, will know where their quarter is going to end until they're basically there. So you do have the option to use your prior quarter as your comparison quarter to 2019.
Okay.
Well, that's a great question. I think it transitions well, Jessica, into kind of the complexity around this, as you're seeing. I mean, with the credit itself, obviously PPP, it doesn't bar you from claiming it, right? But it still needs to be taken into consideration when claiming this credit. And there may be some folks on here that, because I've been on a few phone calls where either their payroll provider has giving it to them to say, hey, go ahead and do this, and we'll sign off on it and get it filed. Or what's interesting is it's really tough to put that on a business owner, right? To say, hey, how are you going to account for PPP? How are you going to look at other wage-based incentives like, WOTC and things like that? And how do those play in, as well as applying the proper, full-time equivalent calculation for your employees. And then what's most important, and this is why we do these full studies, is this full or partial suspension test to your business and how that was impacted. That's a very complex an area that you have to build out to say, how is my business, whether I had a supply chain disruption or delays, if I had employees that normally would be working or traveling, right, and I had to have them work from home, right, what was the impact on their performance? A great example that we like to talk through is take a manufacturing company. A lot of the times they may have a sales team that generally is going to travel to clients, right, or prospective clients, to understand their specific requirements, what are the product needs that they need to have, so they can build out those specifications. That was taken away for a lot of folks, right, during this time. They had to do this over Zoom, which is a very difficult way to actually go through and put together those specs. So what that means, and this is what we do as part of our analysis, is your business still may have had some impact. And for the 2 credits, for 2020, if you're under 100 employees, or for 2021, if you're under 500 employees, if you have a group of folks that was impacted and we can establish that there was more than a nominal effect on your business, then you can qualify and potentially look at all employees, right? So take, for example, a 50-person company, right, in North County, San Diego. If they had a manufacturing floor that they may have had to limit hours, if they had to go through and actually apply new sanitation methods that disrupted their hours, or what I'm constantly hearing from owners is they had to switch vendors, or they had vendors that delayed materials that were getting there, so it delayed jobs. Those all fall within the factors that the IRS has given as guidance. So what can happen there is you can still qualify. And then now you're talking about, for a 50-person company, it could be, the max up to $7,000 per employee in a particular quarter, which can be great dollars back.
So one of the things I wanted to, on that last slide, that interplay of PPP and really a lot of other credits, is and I think this is where your team's going to provide a lot of value, is we have to be really careful that we don't double dip, right? So that the wage that you use to qualify for PPP forgiveness can't also be used for employee retention credit, can't also be used for R&D credit, can't also be, you know what I mean? Like, you can't use that $1 wage for everything. So you have to be able to really keep track of how you're using these wages, because there's so many incentives that are tied to that wage at this point. It's gonna be really important. And I have no idea how the IRS is going to try to audit it, but I gotta imagine there's gonna be a lot of fraud around it, or misuse and abuse. So.
Yeah. Well, and it's a great point. There's either one, it's going to be missed out, right? Or and this is what I'm hearing from a lot of businesses, is that sounds like a lot, I don't have time for it, right? Yeah. Or there's businesses, again, that did pretty well through the pandemic. And so some may say, look, this seems pretty complex and I'm doing okay. But what's crazy is these are good dollars that could be used to, like as an example, a manufacturer actually down in the San Diego area, just for Q1, based off their California folks, they actually got back around $360,000 for Q1. And the reason I highlight that is they're a manufacturer. So what they were able to do with that 360 was actually for all their employees, where they had to decrease a bit of their wages last year, right? And they didn't bonus out like they normally would. They're able to take care of that now for 2021 and make it right for their folks. So
So Justin, this is Eric. So, you know, the scary thing here is I'm going to ask a question I don't know the answer to, and I'm clearly going to justify that while I stayed at a Holiday Inn, I am not a CPA. But an example that might be relevant to some of our participants, and again, in broadly generic terms, to kind of understand this interplay between PPP and whether it's worth going through the hassle, might be a company which qualified for PPP. They went through, they showed the revenue loss, they had gone through that process, they've gotten it forgiven. But when they calculated out the wages, they had a number of employees that had wage payment above the threshold, right? So above that PPP threshold. So those dollars weren't available for to qualify for that proportion or that amount or those dollars that would be flowing into PPP. But they would be qualified under the employee retention credit, so that if they had gone through that exercise and had noted that in their payroll, it's absolutely worth going back and now looking at the ERC to see if you can capture that incremental wages that were on top, you know, above the PPP threshold. Is that correct? Is that a good point?
Yeah, it's an excellent point. Yes, absolutely. So, and that's what we're seeing for businesses, again, that applied PPP to 100% of payroll. They're still qualifying because there's still wages open. So.
And I think, you know, for the attendees on the call and for thinking about how you would then, you know, advise other people in your network and circle, if you think about our blessedly high cost of living Southern California and thus high wage growth, there was a significant amount of wages that would have been, again, payroll wages. These are regular, normal W-2 employees, but they're just above that threshold for PPP. So there should be dollars that are available to be captured through this program. I now will shut up, but I've now demonstrated apparently I can fake my way through being a CPA.
No, it's a good point, and it kind of speaks to, there's just a lot of planning around this in general. So now, you know, we do a lot of consulting around PPP, which is why we brought in a line group for the employee retention credit. I just didn't have more hours to give into researching more of this. But you know, we've got clients where we're still working on their application for the first round and or, you know, second, and we're kind of backtracking. Let's not just put 100% wages because it's easier. Let's just max out the 60, because especially if you qualify for round 2, then you most definitely qualify for the employee retention credit. Let's maximize both of these opportunities, and let's bring in that other 40% of expenses on PPP that, you know, originally we kind of weren't messing with. So there, don't just rush into kind of these assumptions and these thoughts, you know, which is why I wanted to have this conversation. You know, definitely consider the opportunity here to just maximize everything that the government is making available to small businesses. All right. Back to you, Justin.
Perfect. And I just want to highlight, and Jessica's seen these from the studies on the employee retention credit that we're doing. One, we always, our deliverables break out a number of things, right? Lay out the summary, right? Did you qualify or not? But importantly, again, we want to make sure that it's highlighted of how the impact on the business was for COVID, and whether that's a revenue drop or whether that's, you know, more a impact on your business in the factors that we went through. We'll go through, and even if it's both, we'll still build out and illustrate those. What we've done, and this is why we're seeing so many businesses across California claim at least for a single quarter, is we've actually put together a very large database that has every government order, whether it was federal, state, or local, and geographically mapped that out. So if you fall within an area or a region where there were any orders in place, we help cross-reference that for you. And even if your business was deemed essential, right, again, you could still potentially qualify in a quarter because there were orders in place that may have had some sort of disruption on your business. And again, just so we're clear on those potential disruptions, they could be anything from supply chain They could be changes to your hours, right? Limitations on travel. It really runs the gamut. So that's why we always want to make sure we're having that discussion. And again, we'll not only do that, as Jessica mentioned, there's been the complexity of going through the actual calculation of which wages go where. And we have that model constructed so that we can help decipher that out. And then ultimately help put together the actual credit, the pro forma 941. And then we'll work with whoever handles your payroll, whether that's you internally, if you use an outside payroll provider, if you have a PEO, right? If your CPA is helping with it, we can go through and help get those completed and done and make sure the forms get to the right place.
So in that regard, what Justin's referring to is you may actually find that you're going to amend some 941s to claim this credit. So there might be additional paperwork that's necessary, but when you're talking about these dollars, it's worth it.
Yeah, no, that's a great point, Jessica, because I hear this question a lot of, hey, I didn't do this for Q1 or I didn't do this for 2020. Did I miss out? Yeah, to Jessica's point, no, you can go back and amend and to get those credits. Now, the benefit too, though, especially for most of you businesses now for Q2, is we are seeing a faster turnaround time for businesses in getting their credits if they're on a timely filed 941. So if this is something you haven't looked at for even this current quarter, I know things are starting to open up across our area, but it's still maybe some opportunity with the orders that were in place. And Jessica, what I can do, I've got a couple of case studies just around the ERC, but before I go into those, were there any other questions or areas you think I could clarify?
Yeah, there was a few questions. So one's kind of general. What if, you have a revenue drop, but it wasn't specifically related to COVID? I know I've got clients where 2019 was just like a stellar year and they knew 2020 was going to drop. So whether COVID hit or not, they were already expecting that. Do they have to say it was COVID related, or is any revenue drop qualify them?
Yeah, great question. So on the revenue drop, if they just had a decrease, they can still qualify. So you don't have to go back and tie it directly to COVID, because that part's just basically, hey, did you have this 20% drop in 2021 or for 2020 a 50% decline?
What if they're already working with a payroll company and they're, getting this done? What would be a reason for them to still communicate with you if they're already starting to claim these credits?
Sure. No, great question. What we found is with the payroll providers, like I mentioned, I was on a conference call the other day with a large PEO. What's interesting is, one, they are likely underclaiming. At least that's what we've seen. For example, the business that I was speaking to had only claimed $100,000, and it actually turned out they got $600,000, a little over that. And it's because it has nothing to do. The payroll providers have 900 other incentives and credits that they're dealing with. So to actually go through and do a full study and go through each employee to see where those dollars are, it's just not something they have the capacity. So what we would love to do is, we're always happy to have just a gratis call to see if there's an opportunity to help out. If we don't feel like there could be additional credits, then we'll be the first to tell somebody. And then importantly, the other thing is just the work on you as a business. A lot of what I'm hearing from people that we're working with currently is that when the payroll providers are looking at this, they're putting a lot of the work on the business owner or their finance team or accounting team to do the calculation and deliver that over. And our model's a bit different, right? We'll take on the heavy lifting. We'll need to get some data from the business, but at the end of the day, we'll be the ones to do the calculations. We'll go through the complexities of it, really try to have a minimal impact on the time of the business owners, because they've got other things to worry about other than just these credits. So that's just a difference in the model. Again, we've got 5,000 studies in process. We have, 1,200 people to throw at this thing. So if someone needs help, we have the resources to do it and can turn it around, pretty quickly.
Do employee owners' wages qualify for the credit?
It's a great question. So no. So yeah, if you have a business where you've only got 2 or 3 people and they're all owners, their wages won't qualify.
Is there a percentage threshold, or is it any ownership?
Just any employee owner. Yeah.
Okay. And then one question that came through, which is a really good question, a little technical, but we'll go for it.
All right.
It has to do with, how does this impact your taxes, your income taxes? So this is a credit that you take on your payroll taxes, right? So let's say your payroll taxes for the quarter are $100,000 and you get this credit for $30,000, right? So now you're only paying $70,000 in actual taxes for that quarter. So on your books, you're probably only recording that 70,000. How does this play on the tax return?
Great question.
Both federal and state, because they're different.
Yeah. So, and we'll focus on the federal for the employee retention credit. Similar, and we'll go through the R&D in a bit, but yeah, there's a adjustment that you have to make. Similar, it's just an add back to income based off of the wages that are being qualified. So now net, since it's a fully refundable credit, the value of the credit is obviously going to be, much higher, right, and better based off of that adjustment. But yes, if you claimed a $300,000 employee retention credit, you have to make that adjustment back on your deductions, to your taxable income. And then ultimately it'll update that way. So there will be, kind of to Jessica's point, if you went back and you needed to amend, right, for 2020 to claim an employee retention credit, you would also need to amend that the business return to make that adjustment.
Right. So, and that's something to definitely consider, especially if it's not super significant for 2020. What's your structure? If you're a flow-through entity with a whole bunch of shareholders, that might cost a whole lot to amend a return for a relatively small credit. It may not be worth it if you've already filed your 2020 returns. For California, though, you don't actually pick it up as income, right? So it's a nice benefit there.
Yeah.
And then another question that came through about spouses of an employee owner. So if you have someone who owns the company, but his spouse who's not a shareholder also is working, do they qualify, or are they tacked in with the owner?
No, they could qualify. As long as they're getting a W-2 wage, then they could qualify.
All right. So maybe go over, because I know we're already at 9:40 and I want to leave time for R&D. So maybe go over a couple examples and then we'll R&D.
Yeah, and these will be relatively quick. This is just a fabricator that is in the California area. They did have both a drop in revenue. Now, what's great is they actually didn't have a 20% drop in revenue. They had a slightly less than 20%, so they didn't meet that full revenue test. But as you can see, they had some postponed projects, jobs that they couldn't have access to, canceled projects due to their customers. So because of those delays down the chain, they were able to get back over $270,000 just in Q1, right? Another manufacturer in the area, similar. They actually did not have a full revenue decline. They did have their orders drop, and they had to take some of their employees that generally were either out in the field doing sales or doing work that on the line. They had to repurpose those employees. So some folks obviously had to furlough. These folks moved people around. What we were able to find them, again, was over $440,000 just in Q1. Excuse me. And then lastly, now this was a business that hit both. So they did have the revenue drop in 2020 as well as in 2021. So they were still, even though it's a relatively small company, got back over $170,000 in a single quarter. So actually for both quarters, for 2020 and 2021.
And then one last question that was, I'll just real quick hit on this because we actually have the exact same question in our office. If you are a cash basis taxpayer and you are going back to 2020 to take these credits, you still have to amend it because the expense was taken in 2020, and this is an adjustment to expense. We're layman's terms, or for simplicity, we're saying it's other income, but really it's actually an adjustment to expense, which is why you would have to amend your 2020 return, even if you're a cash basis taxpayer.
Yes.
All right, so at this point, we are going to jump into the R&D credits. If there's anyone on the call that's a nonprofit, probably, would be a good time to leave if you don't want to hang, unless you want to hang around, you're more than welcome. I don't know, would you say if they're a service, business would still stick around, might learn something new? What do you think?
Yeah, anybody that's a service business, if your company is, I think the easiest thing, if your company is paying tax as well, because the R&D credit, obviously offsets income tax, it'd be a good thing to hang on to see if this could apply to you with all the changes.
All right, go ahead. Perfect.
Well, so guys, now the R&D credit is a little different, obviously, than the employee retention credit. It is a tax credit that is going to be a dollar for dollar reduction in your actual income tax that's been paid. So what's great, though, is any entity, whether you're a C Corp, an S Corp, Schedule C, LLC, partnership, right, you can claim this credit. And the exciting piece is you can go back, depending on your tax situation, multiple years. At the federal level, you can go back up to 3 years from your date of filing. And then in California, as we all know, not the friendliest tax state, but they do have a very strong state R&D tax credit. So effectively, for whatever credit that you're entitled to at the federal level, it basically doubles because of the California credit. Just a couple of recent changes. In 2016 with the PATH Act, the credit was made permanent. Before that, it was constantly being renewed. They also expanded it for eligible small businesses. So if you're a company that's under 50 million in revenue, like Jessica knows, there may have been pre-2016, the credit may not have made sense for you due to AMT limitations, right? So what was great is they changed the rules. They did put together this ESB rule so that if your business is under 50 million, you could effectively take your tax pretty much to zero. And then with the Tax Cuts and Jobs Act, this was also expanded to for startups. So for businesses that were in their first 5 years that may not have been profitable, so they didn't have income tax, they actually implemented a new rule so that you could use these credits to offset payroll tax as well, up to $250,000 per year. So I think the best way to kind of frame out this R&D credit is to start with the major change in the early 2000s. So when you think about R&D, I think probably most folks on here, especially when you're in the San Diego area, what R&D means is white lab coats, beakers, patents, right? Biotech, which certainly could still qualify. But under the original rules during the Reagan years when the law was enacted, you did have to be bringing something new to the world to qualify for this credit. Now, if you fast forward through the 90s and into the early 2000s, Congress made some key changes. When you think about that time period, manufacturing was the biggest culprit at the time. It was leaving the States. It was heading to China, to Mexico, to India. So what they did was Congress said, how can we make sure that we're incentivizing businesses to stay here? So they made a change to the definition of what is R&D. They took away this new to the world rule and said, if you were doing work that was new or improved to you as a business, then you could qualify for this credit, effectively making this a technical jobs credit to reward any businesses that were using U.S. labor to do work here domestically in the U.S. And they listed out like key requirements. So again, if you were doing something new or improved to you, right, you were working through to eliminate any sort of technical challenges, right? So project specific work, right? And going through an iterative process, then it's something you could qualify for. Traditionally, you had to have that discovery of something brand new, and that's now been taken away. So And look, I can actually get Jessica and Eric to try this out, or maybe Eric. Like when we think of, these are the specific business components, right, that they have laid out for us. Like Eric, what do you think of when you think of a product? What comes to mind?
You know, something physically tangible or an intellectual property activity or something that has, you know, IP behind it or in it.
Perfect. Yeah, like think of, I think we all have these phones, right? We have iPhones, Blackberries for some of the folks that are loyal. What we do is when you think of that simple product, right? That's constantly having new functionality, performance, or reliability or quality being made to it, right? Or take the same product, there also may need to be a completely new or changes to the process to manufacture that product, right? Or to make it. The software, like Eric mentioned, the IP and the tech that's involved in it is constantly being updated. The techniques, right? And then you see some of the old rules still apply, right? If you are bringing stuff that's an invention that's still new to the world, then it can qualify. But so long as, again, this is an activities-driven incentive, so long as the function or the performance or the reliability or the quality are being improved or being enhanced, then that time can qualify. Now, what does that even mean and how do you quantify it? That's where, again, Congress laid out, here are the three key areas, right? If you're using U.S. wages, right, so your W-2 employees, or even like Jessica's question around owners on ERC, for R&D, we see business owners can still qualify, right? A portion of their time and income. Then supplies. So for anybody that's doing prototyping or even making any sort of products or testing out new processes and they're having scrap, right? Some of those supply costs can be recouped so long as that activity is happening here in the US. And then lastly, even outside contractors. So if you're using outside vendors or subcontractors to do work for your business, a portion up to 65% of that cost could also be captured toward this credit. And I think this is a very helpful graphic just to kind of lay out again the whole intent behind this is, you know, when you think of the businesses right now claiming this credit and all the businesses across, even just looking only in California, this credit is severely underclaimed. And that's why we always want to make sure we're working with CPAs as well as any group that will host us to educate on this. The biggest thing that's concerning here is when you look at where the U.S. ranks, right, in R&D generosities, we think we're doing really well, but we're still number 27, right? So we can still improve, right, and help these businesses. The other thing is when you look at the dollar figures here, you have $9.6 billion for companies that are over 250 million in gross receipts, and then only $1.6 billion for companies with less than 250 million in gross receipts. I highlight that to mean small to medium-sized businesses are missing out, right, on this. And I think we can all agree the Amazons and the Pfizers of the world really don't need any more tax credits. And what's great is these are out there. So if your business is claiming or is having tax liability, this can make a lot of sense. And I've got a few case studies to go through here, but Jessica, I don't know if there were any questions or things you'd like me to clarify before going through some of these. Oh, you're on mute, Jessica.
Sorry about that.
No
Definitely
problem.
want to talk about some industries and especially those that people just may not think that would qualify. And then maybe we can touch quickly, you know, yes, it is an income tax credit, but there is a small group of businesses that could actually use it against payroll taxes. Do you want to touch on that real quick?
Yeah, absolutely. So what Jessica's referencing on for the income tax piece is, again, when the credit was expanded with the Tax Cuts and Jobs Act, what they also did was they created a new startup credit. So if you are a business that, you know, is in your first 5 years, you're getting up and running, you have payroll, but you're still not profitable, you can still potentially claim this credit up to $250,000 per year against your payroll tax liability. And I'd tell you with, like Jessica brought up service companies earlier, what we're seeing is like software companies, software startups, even engineering startups that are just getting going. This can be a good way to keep some cash. And then again, you can still take PPP, ERC, as well as R&D, right? So when you're looking at all of those dollars that could go against the payroll tax, it could be really significant for a business.
And I think the other thing to touch on is maybe go a little bit into, you know, the type of activities that qualify, because, you know, you and I had a pretty good conversation in the office. You know, like the engineering and architecture firms, like that just seems like, what are they doing? Why would they be getting this credit? And further, everything's contracts, so they're getting paid for everything. They're not doing a whole lot, you know, internal R&D. And a lot of people think, oh, internal R&D, that's easy, but what about stuff that's done on client work?
Yeah, no, great question. So let's take an architecture firm, for example, right? How do they qualify? Well, the business components that were laid out, whether it's the product or the process, generally an architect's product is going to be a design, right? Or a set of documents that they're going to provide to their client. What's great is the whole goal behind this credit is if it's new or improved, so if there's any changes to that design process, right, or to that actual design, then the time being spent by those individuals going through iterations using CAD, right, using Revit if they're using a different simulation software, to actually refine those designs to meet specific project or site-specific requirements, that time can qualify. And then that's quantified through their wages. So what's so great for architects, engineers, and any service company that's doing simulations or models or using CAD or those types of tools is the regulations are clear. It lays out, those are specific examples of qualified activity. And then the other nice part is when we talk about wages and who qualifies, like let's say you have your architect that's doing that design, you can also take one tier up and one tier below of activities. So what I mean by that is if you have a supervisor that's directly supervising that activity being performed by that architect, let's say a principal, right? Then that person's time in a supervisory, right, or a quality review capacity can also qualify. And then similarly, that person that's directly supporting that architect, right, whether they have a draftsman or whoever, then they can also qualify. And then, Jessica, your other question is great because, yes, we hear this all the time. Hey, I'm getting paid for my work, right? I'm doing this. Like, how can this be R&D? What's great is, yeah, I mean, the whole goal behind the credit is that you're offsetting income tax. So there's somewhat of an expectation that you're getting paid, right? Hopefully doing well. The other part is that's part of the analysis that you have to do. And that's where we step in. You do have to look at the contracts to understand how is the taxpayer being paid. But ultimately, if they're being paid on a lump sum, right, or a fixed fee, or even a time and materials to a cap, right, they could still potentially qualify. And that's part of our analysis. So yeah, in summary, just because you're getting paid for your work, like take this manufacturer, for example, they're clearly getting paid for every widget that they create, right? But they can still qualify for this.
So Justin, I would be remiss if I didn't pitch you one of North County's I don't know biggest, but one of our funnest industry clusters. Can craft brewers, craft beverages, can they claim the R&D credit for introducing a new product into the marketplace?
Eric, you just hit on my favorite clients to go visit. So yes. Yeah, absolutely. They do. I mean, we work with several breweries, wineries, craft breweries. Now, as Jessica knows, the whole point there, and this is why we always want to make sure we're talking with their CPA or their tax team, is are they paying tax? But generally, if they are paying tax, then they could be great for this credit. Their products, their processes, formulations, tasting profiles.
Even agriculture in general, that was something we learned. You know, there's just so much that agriculture is doing, and especially in California, where they've got to constantly adjust to, you know, what water shortages or whatever it may be. They've got to strengthen their plants. They've got to experiment with their plants. That even qualifies.
Yeah. Yeah. Any of your folks that are growing leafy greens, right? We work with a lot of vineyards as well. Agriculture has been really good. It's funny that you bring that up, Jessica, because I'm sitting one office over from former Secretary of Agriculture, Mike Johans. So he can probably hear me right now talking, but he helps lead our ag practice specifically, because this was really important to him, that any business in the ag space knows about this credit. So
what about like construction? There's a lot of construction industry in our region.
Yeah, no, great question. So construction, if they are doing a lot of design, right? If they're doing design build work, and they are very involved in the design, and they have, you know, maybe a couple of engineers on staff, then we've seen them be very good for the credit. Now, your general contractors that, you know, may not be as heavy on the design side, they're more in a project management capacity, not as good for the R&D credit. However, you've also hit on, Jessica, a great industry for ERC. The construction industry as a whole, even they're a great example of folks that their revenue may have been up, but they were certainly hit due to either jobs being shut down or vice versa.
All right. Do you want to go over maybe a couple examples?
Sure. Yeah, I can go through just a couple. I mean, I'll hit, I know we in San Diego, as well as going even further up, you know, from aerospace, always a great industry. Here, just what I wanted to highlight, you saw not only did they come up with new design concepts, but they also did new testing methods. The point here, I mean, $100 million company, so relatively large, but got back over 4.2 million when you look at both federal and California credits, right? So that is really exciting. And then another area that folks don't understand are dental labs. There's a lot across San Diego, Northern County, as well as, you know, just Southern California in general. These have been also very good for the credit. They're doing very specific, right, patient-specific manufacturing and milling and coming up with new processes. So if there's a dental lab or someone you know, here, I mean, only a $5 million company got back over $675,000 in credits. And again, our model, and the reason we highlight this is these guys, any business owner is busy. They don't really have time to sink, you know, hours upon hours into calculating tax credits. So that's where we as the experts can come in and help get the right dollars. You touched on this before on the services side, Jessica. So I just want to highlight integrators, right? Folks that are doing, this is a process controls integrator, but even folks that are doing AV, fire protection, security, that are taking those technologies and integrating them into buildings, they've been also very, very good for the R&D credit. And generally what we're seeing is across California is they're looking at pretty large tax bills because with all the schools and everything being closed, they actually ended up doing a lot of projects. So this is another group of folks, they're coming up with custom solutions. And when you think of just the Internet of Things, I know just going into my own place, my air conditioning unit is hooked up to somehow to my phone, and then that's got to communicate with my TV. Like everything is now connected. And that's what these types of businesses do is help optimize that. I kind of have Eric hit on for the brewery side, similar on the food processing. This is another industry where, again, they're coming up with either new products or more importantly, coming up with improvements to their own process lines. This business here, only 11 million in revenue, got back over 130,000. And then this is the last industry I did want to quickly highlight. There's over 180 80 industries that can qualify for this credit. But specifically in the San Diego area, there are a lot of government contractors, IT consulting, digital transformation companies that may not identify themselves as an R&D company or a product-based company, right? They consider themselves a service or a consulting company. What's crazy is they can still qualify because with the whole extension of rules around software and software as a service and internal use software, is if your company is in any way trying to improve solutions or is using, for example, low code to come up with a customized business solution for your customer, that time being spent by those employees can qualify. And here, I mean, it led to a pretty lucrative benefit just even at the federal level for this business.
I think in general, especially in the last, 12, 18 months now of COVID, a lot of people had to get creative and innovative to adjust to, what was thrown at us so quickly. So there may be things where maybe a company isn't normally engaged in that kind of activity all of a sudden was. So I think there's probably a lot of opportunity this year in particular would be my expectation.
Yeah, no, and we're seeing it all the time. There's a plastics manufacturer that plastic injection molding company that I've worked with for years, and they took a hard right and started making dividers and customized classroom solutions, right? And that's just, they pivoted their business, and there's a lot of stories like that. You're right, Jessica.
So we do have one question. It's a good one about the ERC. If they're behind on their payroll taxes, they're hit hard by COVID, they still have their employees, but they're a little bit behind on now paying those, can they still claim the credit? Yeah,
can still claim the credit. Now, you won't be able to apply them against if there are any penalties or anything. Obviously, the credits can't go against that. But yeah, it doesn't bar you from claiming the credit. You could still go back, recoup, and it could be a good way to offset that backlog of costs.
Well, we're at 10 o'clock, just a little bit after. So we're going to wrap it up there. Jessica and Justin, thank you so much for, I think, what was a really illuminating and enlightening discussion. For the attendees, just note slides and a recording of this webinar will get mailed out to you a little later today. We expect it probably mid-afternoon, so be looking for your email from me. With those, it'll take you to the SDNEDC website where you can link it. We'll also include in that email Jessica and Justin's contact information. So should you want to follow up with either Polito or Alliant Group for some specific questions and to explore specific solutions, you can. Again, we're excited to bring these webinars to the North County business community. Should it be available in your budget, we'd love to talk to you about becoming investors, members. We call our members investors in North County Prosperity. And again, Jessica and Justin, thank you so much for putting on this webinar for us today.
Thank you, Eric.
Absolutely.
Great. Have a great rest of your day, folks, and we'll talk to you later.
Bye.